Hi, this is Mike Larson from Money and Markets TV. Despite trillions in printed dollars, euros, pounds, and yen, despite the passage of almost 4 years since the heart of the credit crisis, and despite all the proclamations of government bureaucrats and central bankers, the economy and capital markets remain on the ropes. Just consider the U.S. real estate market. We already know that housing starts have fallen to their lowest level since October, and now we've learned that sales of existing homes have weakened as well. They were down 2.6% in March, a bigger drop than expected and the third decline in the past 4 months. Meanwhile, new home sales fell more than 7% last month, and a recent slump in builder confidence and buyer traffic foreshadows even weaker results in the future. So much for the vigorous housing rebound we keep hearing about, huh? And then what about manufacturing? Well, durable goods orders just imploded by 4.2% in March. That was way worse than economists expected, and the biggest decline in any month going all the way back to January of 2009 when we were mired in a deep recession. And things aren't getting any better overseas either. The UK economy officially sank into its first double-dip recession since the 1970s. The cost of insuring Spanish debt against default just hit a record high. Sovereign bond yields continue to climb in countries like France and Italy, and even the relative cost of borrowing for Europe's main bailout fund, the EFSF, just hit its highest level in 4 months. How can the fund come to the rescue of indebted sovereign nations if its own cost of raising money is rising so sharply? The answer is it can't. All this evidence points to one conclusion: the unchecked money printing by global central banks just isn't working. But the powers that be just keep calling for more of the same. Case in point, Fed Chief Ben Bernanke just said that, quote, "we remain able and willing to take further action," end quote. And that means more money printing if the economy weakens. This, despite the fact that quantitative easing, or money printing, or QE, we surely know only gooses asset prices while accomplishing little to nothing for the real U.S. economy where those of us work, save, and invest. As a result, the Fed has nearly tripled the size of its balance sheet to almost 17% of GDP in the past few years. The ECB and Bank of Japan have balance sheets that are around 30% of GDP. With no end to this insane monetary policy in sight, your best course of action as an investor is to target select vehicles that will benefit from further money printing. Think higher yielding alternatives to treasuries like dividend-paying stocks or safer corporate bonds. At the same time, you want to avoid those investments that are more leveraged to the real economy. I've already warned about the risks to housing-related stocks. Now, I would add many globally diversified manufacturers and technology companies to that list. I'm Mike Larson for Money and Markets TV. Thanks for watching.